Hi everyone, it's Chad back with another video, and today I'm going to be talking about Deere and Company, better known as John Deere. Fantastic business that's performed admirably this year, up 26% year to date, vastly outperforming the S&P 500, which is down in the 15 to 20% range. It's a dividend aristocrat with over 30 years of consecutive dividend growth, it's sitting at around a 1% yield right now, which is not so impressive below S&P 500 average, but this combined with the returns this company has been provided over the last 5 and 10 years looks for a really solid investment. So we're going to analyse how it did with its most recent earnings, it was up 5%, pushing the 52-week highs. Analyse how it's valued right now, how this business is performing, and how it's likely to perform in the future, and whether I think this is a buy, sell, or hold right now. So, just about to get into it, like, subscribe, and enjoy the video. The most recent earnings were nothing short of fantastic. Net sales and revenue, $15.5 billion for the quarter. That's up 37% year over year. This is for a company trading at roughly 20 times earnings, clearly seen as a slow growth industrial, and it's growing sales at 37% year over year. That is absolutely outstanding. This is mostly due to vastly increased tractor sales than would previously have been expected. Net income almost doubled to $2.2 billion. That's up 75% from $1.2 billion the year prior. Diluted earnings per share $7.44. That's up 81% from the year prior. Absolutely outstanding numbers, and this carries over into bringing the average up for the full year results, obviously due to these fantastic tractor sales. The full year results for all 2022 were again really strong. Net sales and revenue up 19% year over year to $52.5 billion. Now that's up around $8.5 billion from the previous year. But half that was just this quarter's increase in revenue because of those huge tractor sales. So that does push the average up significantly. However, this is still a really strong year for a company of this age, scale, profile. Net sales up 21%, net income up 20%, and diluted earnings per share up 23%. These are all excellent numbers in my opinion. Really strong performance from this company. Whether it's had a robust cycle or not, doesn't really matter to me. All that matters right now is the current results, and they look really strong. Will it be hard to repeat this in 2023 and 2024? Yeah, probably, but I think these numbers are pretty good. Their outlook for 2023 is net income of between $8 billion and $8.5 billion, compared with $7.1 billion this year. Absolutely outstanding growth again. This company continues to roll on all cylinders, and of course they are seeing a robust cycle at the minute, but how long will that continue for? That is way outside my scope of expertise in my opinion. Net operating cash flow prediction between $9 and $9.5 billion. This would be an absolute winner for this company. $130 billion market cap, so that'll put it around 13 times operating cash flow. Really strong. One thing that's really important for me when analysing companies like this, particularly dividend aristocrats like John Deere, that are going to be income plays and you really want to provide you some margin of safety going forward, is the capital allocation strategy and the balance sheet. Now I'm going to talk about the balance sheet in a minute. It is absolutely less than perfect, but their attitude towards use of cash and the capital allocation seems absolutely outstanding for me. They believe that the hierarchy should be committed to maintain the A rating, so managing the balance sheet liquidity to support a rating that provides access to low cost and readily available short and long term funding mechanisms, because of course this is a very asset heavy business. If you're building tractors, these are expensive pieces of equipment, so that it is a high capex system and it needs a lot of operating cash flow to maintain this. Fund and operating growth needs, so fund value creating investments in the business in the future. There's a lot of potential growth in the widening ag tech industry that John Deere is hoping to cash in on. Then comes the common stock dividends. This is obviously very important to this company. They're targeting a 25 to 35% payout ratio of mid-cycle earnings. It's going around 20%, so they're way below that right now, which is only good news. But of any dividend aristocrat is going to be interested in maintaining a model of raising the dividend going forward. And then finally, share repurchase, so returning cash to shareholders in another way to dividends, which seems an appropriate use. Maybe not right now because the stock has been on an excellent run, but if the stock dips at any point, I can see them repurchasing shares at a decent rate. Next, onto the dividends. John Deere was a dividend aristocrat until the pandemic, where it had to lower its dividend very slightly, so you can see that the payout is only minutely lower. They had previously over 30 years of rising dividends, sitting at a 1% yield right now, lowest it has been in a long time due to the strength of the price. Payout ratio of just 19%, 5-year growth rate of 12.5%, so regardless of the drop, that's still a really strong 5-year growth rate, much higher than the average dividend aristocrat in my opinion. And while this isn't the highest yielding company in the world, this has provided excellent returns on capital from share price appreciation in the last 5 or 10 years and has generally been a fantastic stock to hold over pretty much any period. You can see since the early 2000s, the stock price has positively ballooned to where it is today. The dividend payout has followed. It's around 29 cents in 2003, I think. It's now $4.50. That's excellent returns. The prevailing reason for the lack of raising the dividend in the pandemic was because of the balance sheet. It has a cash debt ratio of just 0.1, which is pretty poor for the industry, and while it's okay for John Deere's history, it's not a situation you want any business to be in. It's actually not ridiculous for dividend aristocrats of these companies with these size and scales, and as asset heavy as John Deere is, it needs a lot of capital and frequently takes on debt to acquire this capital. So pretty much any balance sheet metric not going to look very favourably on this company. As an Altman score of 3.1, meaning it's potentially at risk of financial distress. I can't really see this because this company has such strong cash flows. As a debt to EBITDA of 5.3, which is not great, but it's definitely improving versus where it's been. Overall, the balance sheet is by far the biggest element of this company that concerns me. However, it's continued to be a performer over the long term, has strong return on invested capital. I think as long as they prioritise maintaining the rating and maintaining access to liquidity, I think they're going to be fine. From a margin point of view, excellent. 29% margin in this realm is fantastic, and they convert that to a 16% operating margin and just shy of 13% net margin. Both absolutely fabulous in my opinion for this industry and for a business of this size and scale. Return on equity percentage of 13.3% is absolutely outstanding. Return on assets, again, this is a very asset heavy business, but return on asset percentage around 7.4 for a business of this size, scale, maturity again is pretty good and very strong for John Deere's history. John Deere has excellent management in my opinion. Return on invested capital around 9% is kind of what I'd be looking for a dividend aristocrat. It's not outstanding by any means, but this is a nice place to be. Next, and perhaps most importantly, onto valuation. For any company like this, dividend aristocrats or dividend aristocrat-like companies or former dividend aristocrats, valuation is key. And while dollar cost averaging can certainly save you in the long run, you don't want to be paying too high a price. Free cash flow this year has been minimised, and operating cash flow also took quite a hit. So those numbers are absolutely ridiculous right now, but are not really representative of this company going forward. It's normally around $16, $17 per share this year, something like $2. So that is obviously very overpriced by these metrics. On a price to earnings ratio, on a trailing basis, it's around 19. On a forward basis, 17. These are both above the S&P 500 averages, but I think we all believe that John Deere is an above average company, so you wouldn't mind going forward paying slightly over the odds for this company, as it has previously had a strong dividend history. It has a dominant position in the market, and it looks like it's growing revenue and net income at strong rates. Personally, I think it's a bit worrying to see the price of free cash flow this high. Thus, really doing a DCF is pretty pointless with the numbers we have, and using previous numbers is kind of too much protection. So I wouldn't be comfortable investing without doing a proper discount cash flow analysis, and I'd be quite happy to wait a few quotes on this one to see the valuation come more in line. With that being said, in recent history, there's never really been a bad time to own John Deere. It's gone up 26% year to date, and it's still around S&P 500 averages or just above in terms of price to earnings ratio. It's been a fantastic company and a real safe haven in the last few years for a lot of investors. Still pays a decent dividend, has a long history of dividend growth even if skipping a year, and then it's a fantastic company moving forward. I'm just not completely comfortable paying with the reduction in free cash flow it's seen, considering the strain that could put on the balance sheet. However, if they return to decent free cash flows, which I believe they will, I just want to see that in first, and if the price maybe comes down a bit, I'll be much happier paying a forward price to earnings around 14 or 15. So if there's a potential recession, I could really see that happening as people move to the safety of bonds or something like that. So if this company was, 380 or below, I'd be really happy in purchasing some shares of this company. However, you should do what you want. You should not listen to me. I'm not a financial advisor, so if you wish to buy shares or anything, you should do your own due diligence or contact a financial advisor. Like and subscribe and enjoy the video. I'll see you next time.